Are you tired of feeling like your money is just sitting there, losing value every single day? Do you see headlines about the stock market and feel like you're missing out on a huge opportunity to grow your wealth? If you've ever thought about investing but felt overwhelmed, confused, or just didn't know where to start, then this video is for you. Today, we're going to break down the simple, powerful steps to start investing in 2026. No jargon, no complicated charts, just a clear roadmap to get your money working for you. By the end of this video, you'll understand why investing is essential, what to invest in, and exactly how to take your first steps. So grab a notebook and let's get started on your journey to financial freedom. First, let's talk about why you absolutely need to be investing your money. The biggest reason is a silent wealth killer called inflation. You've probably noticed that your groceries, gas, and just about everything else gets more expensive over time. That's inflation at work. As of late 2025, inflation has calmed down to below 3%, but it's always there, slowly eating away at the purchasing power of your savings. If your money is just sitting in a regular savings account, it's actually losing value. The interest you earn in a typical savings account is almost always lower than the rate of inflation. So, while your account balance might go up a tiny bit, what you can actually buy with that money goes down. Think of it like this. If you have $100 today and inflation is 3%, that same $100 will only buy you $97 worth of stuff next year. That might not sound like a lot, but over 10 or 20 years, it adds up to a massive loss of your hard-earned money. Over 20 years, that $100 would only have the buying power of about $54. You'd lose almost half your money's value just by letting it sit there. The only way to combat this is to make your money grow faster than inflation. And that's where investing comes in. Historically, the stock market has been one of the most effective ways to beat inflation. In fact, studies have shown that stocks have outperformed inflation about 90% of the time over the long run. By investing in the stock market, you're not just protecting your money from losing value, you're actively growing it. While a savings account might give you 0.5% interest per year, the stock market has historically returned an average of about 10% per year. Now let's talk about the second reason why investing is so powerful: compound interest. You might have heard this term before, but do you really understand what it means? Compound interest is basically earning interest on your interest. It's a snowball effect for your money. Let's look at a simple example. Imagine you invest $1,000 and get a 5% return each year. After the first year, you'll have $1,050. Now, here's where the magic happens. In the second year, you're not just earning 5% on your original $1,000. You're earning 5% on the entire $1,050. So, you'll earn $52.50, bringing your total to $1,102.50. It might not seem like much at first, but over time, the growth becomes exponential. After 10 years, that original $1,000 would grow to about $1,629. After 20 years, it would be $2,653. After 30 years, it would be $4,322. And after 40 years, it would be over $7,000. You can see how the growth accelerates over time. That's the power of compounding at work. That's why starting early is so important. The longer your money has to grow, the more powerful the effect of compounding becomes. It's not about how much money you start with. It's about how much time you give your money to grow. Time is more valuable than the amount you invest. Let's say you start investing just $100 a month at age 25. By the time you're 65, with an average annual return of 8%, you could have over $300,000. But if you wait until you're 35 to start, you'd have to invest almost double that amount each month to reach the same goal. If you wait until 45, you'd need to invest about 4 times as much. Every year you wait costs you tens of thousands of dollars in potential growth. Okay, so now you know why you need to invest. But what should you invest in? For beginners, there are 2 fantastic options that are simple, effective, and accessible: index funds and exchange-traded funds. Let's start with index funds. An index fund is a type of mutual fund that holds a collection of stocks designed to mimic a specific market index, like the S&P 500. The S&P 500 is an index that represents 500 of the largest companies in the United States. We're talking about companies like Apple, Microsoft, Amazon, Google, Tesla, and hundreds of other household names. So when you invest in an S&P 500 index fund, you're essentially buying a small piece of all 500 of those companies. This is a great strategy for beginners because it's instantly diversified. Instead of trying to pick individual winning stocks, which is incredibly difficult even for professionals, you're spreading your investment across a wide range of successful companies. This significantly reduces your risk. If 1 or 2 companies in the index don't do well, it has a much smaller impact on your overall investment. Index funds are also what's known as passively managed. This means there isn't a team of expensive fund managers actively buying and selling stocks to try and beat the market. Instead, the fund simply follows the index. This passive approach means that index funds have very low fees, which is a huge advantage for you as an investor. High fees can eat into your returns over time, so keeping costs low is crucial. Some of the most popular and low-cost index funds for beginners include the Vanguard 500 Index Fund, which has the ticker symbol VFIAX. There's also the Schwab S&P 500 Index Fund, ticker symbol SWPPX, and the Fidelity 500 Index Fund, ticker symbol FXAIX. Some, like the Fidelity Zero Large Cap Index, ticker symbol FNILX, even have a 0% expense ratio, meaning you don't pay any management fees at all. Now let's talk about ETFs. Exchange-traded funds are very similar to index funds. They also hold a basket of stocks and are designed to track a specific index. The main difference is how they are bought and sold. ETFs trade on the stock exchange just like individual stocks. This means you can buy and sell them throughout the day, and their prices fluctuate accordingly. This makes ETFs incredibly flexible and accessible. You can buy as little as one share or even a fraction of a share through most brokerage platforms. This is a huge advantage for beginners who are just starting out with a small amount of money. You don't need thousands of dollars to get started. You can literally start investing with just a few dollars. Popular ETFs for beginners that track the S&P 500 include VOO, which is the Vanguard S&P 500 ETF, and IVV, which is the iShares Core S&P 500 ETF. Another popular option is VTI, which is the Vanguard Total Stock Market ETF. VTI tracks the entire U.S. stock market, not just the 500 largest companies. And just like index funds, ETFs have very low expense ratios, making them a cost-effective way to invest. So, to recap, both index funds and ETFs are excellent choices for beginners. They offer instant diversification, low costs, and are incredibly easy to invest in. You don't need to be a stock market genius to get started. You just need to pick a broad market index fund or ETF and start investing consistently. All right, you're convinced. You're ready to start investing. But how do you actually do it? It's much easier than you think. Here's a simple step-by-step guide to opening a brokerage account and buying your first ETF. Step 1 is to choose a brokerage. A brokerage is simply a company that allows you to buy and sell investments like stocks and ETFs. There are many great options out there, but for beginners, some of the most popular and user-friendly choices are Fidelity, Charles Schwab, and Vanguard. These are all reputable companies with long track records, and they all offer commission-free trading for stocks and ETFs. This means you won't pay any fees to buy or sell your investments. When you're choosing a brokerage, look for one with a user-friendly platform, good customer service, and no account minimums. This means you can open an account and start investing with any amount of money, no matter how small. Step 2 is to open your account. Once you've chosen a brokerage, the next step is to open an account. This process is usually done entirely online and only takes about 15 minutes. You'll need to provide some basic personal information, such as your name, address, date of birth, and social security number. This is required by law to verify your identity and prevent fraud. You'll also be asked to choose the type of account you want to open. For most beginners, a standard individual brokerage account is the way to go. This is a taxable investment account, meaning you'll have to pay taxes on any investment gains you make. Step 3 is to fund your account. After your account is open, you'll need to fund it. This is as simple as linking your bank account and transferring money over. You can usually do this electronically, and the money will be available in your brokerage account within a few business days. Some brokerages even offer instant transfers, so you can start investing the same day. Remember, you don't need a lot of money to start. You can start with as little as $50 or $100. The important thing is to just get started. Step 4 is to buy your first ETF. Once your account is funded, you're ready to buy your first investment. Let's say you've decided to invest in an S&P 500 ETF like VOO. You'll simply search for the ticker symbol VOO on your brokerage's platform. You'll see the current price of one share. Now, you have a choice. You can either buy a specific number of shares, or you can invest a specific dollar amount. This is called fractional share investing, and it's a game changer for beginners. Let's say one share of VOO costs $400, but you only have $100 to invest. With fractional shares, you can buy a quarter of a share. This allows you to start investing in your chosen ETF right away, even if you can't afford a full share. Once you've decided how much you want to invest, you'll place your order. You'll typically choose between a market order, which buys at the current price, or a limit order, which only buys if the price reaches a certain level. For beginners, a market order is usually the simplest option. And that's it. You are now officially an investor. Congratulations. Now that you're an investor, there are a few key principles to keep in mind to ensure your long-term success. Investing is not a get-rich-quick scheme. It's a long-term strategy for building wealth. First, be consistent. The most successful investors are those who invest regularly, no matter what the market is doing. This is a strategy called dollar-cost averaging. By investing a fixed amount of money every month, you'll buy more shares when prices are low and fewer shares when prices are high. This smooths out your returns over time. Set up automatic transfers from your bank account to your brokerage account every month and make investing a habit. Second, think long term. The stock market goes up and down in the short term. That's normal. But over the long term, it has consistently trended upwards. Don't panic and sell your investments when the market has a bad day or a bad month. Remember, you're in this for the long haul. Stay the course and don't let short-term noise distract you from your long-term goals. Third, understand your risk tolerance. Everyone's financial situation and comfort level with risk is different. As a young investor, you have a long time horizon, so you can generally afford to take on more risk. As you get older and closer to retirement, you may want to shift your portfolio to be more conservative. The key is to create a portfolio that you're comfortable with and that aligns with your financial goals. So there you have it, the simple, powerful steps to start investing in 2026. You've learned why investing is essential to beat inflation and build wealth through compound interest. You've discovered that index funds and ETFs are the perfect way for beginners to get started. And you now have a clear step-by-step guide to opening your own brokerage account and buying your first investment. Remember, the journey to financial freedom starts with a single step. Don't let fear or uncertainty hold you back. You have the knowledge and the tools to take control of your financial future. Start small, be consistent, and think long-term. If you found this video helpful, be sure to hit that like button and subscribe to Frankie Finance for more simple, actionable financial advice. And if you have any questions, leave them in the comments below. Thanks for watching and see you in the next video.